Hello, this is Dr. Adam J. Bock. In this brief audio presentation, we're going to begin our conversation about finance. In this particular presentation, we're going to focus on two elements of early stage capital, bootstrapping and crowdfunding. Bootstrapping, in fact, is not a way to raise external capital. It's the idea that you grow the company initially using internally generated capital and by restricting the amount of capital that you need. The word comes from the expression pulling yourself up by the bootstraps, which is obviously a fairly stupid description. But it's a standard phrase now that's used pretty consistently in terms of how early stage companies operate, and so it's important that you recognize what it is. What we're really talking about is starting small, accessing cheap and free resources wherever possible. So, for example, not getting an office, but simply running the business out of your home, or possibly using co-working space, or even trying to find free space that another organization isn't using. Wherever possible, leveraging your network to get what you need at better prices or free in any situation that comes up. Avoiding large expenditures. This is a tricky one because very commonly there's confusion about whether you're trying to avoid large expenditures in the short term or the long term and how these impact your fixed and variable costs. So for example, rather than purchase a piece of capital equipment, you might rent the use of that type of equipment from another organization. Now this seems like a savings in the short term because you don't have the large outlay to purchase the machine. But in fact, the odds are good that your variable costs are much higher than they would be if you could purchase the machine. So you're trading off access to cash now for higher variable costs, as long as you continue to operate in that mode. The point being that as you scale, you'll need to step away from that kind of thinking. But in the short term, if it helps you avoid having to raise capital, it can be beneficial. The whole framework here is to grow the business organically with internal cash flow by limiting the amount of actual cash that you need and getting to sales as quickly as possible. There are some big advantages. One of the biggest ones is that it limits outside investors who might take control of the organization. It keeps you focused on the key success factors of the business. You need to be laser focused on day-to-day operations and how much cash you're generating. It ensures that you don't go bankrupt for purely financial rather than business reasons. There are many situations in which early stage companies grow faster than they can finance and ironically run out of cash while they're growing very, very quickly. Bootstrapping tends to avoid that. It also teaches useful long-term lessons about running lean and efficiently, which are valuable for organizations in the long haul. Some situations, what we've seen are early stage companies that raise a lot of outside capital and get used to having lots of cash all the time. That inevitably tends to go away. There are very few companies, with some fairly big exceptions like Google, that generate lots of capital. Anecdotally, it's much harder to start with lots of cash and then learn to run efficiently. It's much better if you learn to run efficiently now. And if you have more cash later, you can still choose to run efficiently, or you can choose to run less efficiently if there's a good reason for it. Bootstrapping keeps your whole team focused and aligned on the critical near-term goals. But there are some big disadvantages to bootstrapping. The single biggest one is generally that it tends to be slow. Because you have limited capital and you're attempting to stay very focused on getting to market quickly, you may miss out on other opportunities that could emerge. You could be overtaken by competitors who are willing to accept growth capital. If you have two organizations, one of which tries to bootstrap, the other one of which goes out and raises a lot of money, it's quite possible that that high capital raise will help that second company get into the market faster. Of course, the founders will have given up a lot more ownership. So this is a fundamental challenge we'll talk about in the next presentation as well, associated with what's more important to you: control, long-term financial returns, how quickly you get to market. There's limited room for error if you're going to bootstrap because you don't have a backstop of cash in case things go wrong. if you're over-reliant on your network, that can limit how much exploration you do and your access to unfamiliar or novel resources. The network's a powerful thing, but if you get too dependent on it, it can limit your horizon. And although it tends to be easier to go from being efficient to being less efficient later on, bootstrapping does create a mindset that can be hard to change. We do sometimes see situations in which entrepreneurs who've been very effective at bootstrapping aren't then able to grow a firm faster even when the resources are available. So we want to distinguish that from crowdfunding. And importantly, we want to make sure we distinguish crowdfunding from crowdsourcing. Crowdsourcing is accessing resources and generally knowledge from a large group of people. Crowdfunding is accessing capital specifically, usually from an online audience. The idea is that you're getting small contributions from a large number of people. This is a large and growing mechanism for raising money around the world, and it's quite likely that it will overtake some other standardized forms of private capital raising like angel and VC funding. Be aware that it has different regulatory frameworks in different countries. So for example, in the United States, you could not do equity crowdfunding until very recently. And there are all sorts of regulatory reasons for it, which are not directly relevant here. Your book does a good job of walking through some of those issues. But just recognize that this isn't the same on a global basis. There are a variety of different types of crowdfunding. So equity or investor crowdfunding is where you actually are selling stock. You're selling ownership in your business to a variety of different people, potentially many of whom you don't even know. There's rewards-based crowdfunding, where you offer something up other than ownership. So for example, if you are creating a symphony, you might provide a reward of either attending rehearsals or a download of the recorded event once it's done. Any kind of sort of recognition or product related to it could be rewards-based crowdfunding. And this can be used as a pre-selling mechanism. So most famously, it's being used for board games, including games like Exploding Kittens, very successfully, where supporters put money in, and then when the game is produced, their reward is a copy of the game. There's a patronage mechanism where people, predominantly creative artists, are simply looking for funding where there's not a direct return other than the satisfaction of having supported a creative process. And there is loan-based crowdfunding in which the backers become loan holders. This is a little less well developed, but it's worth being aware of because it gets around some of the regulatory issues that are associated with equity and investor-based crowdfunding. There's a lot of considerations to be taken in terms of crowdfunding. Crowdfunding's gotten a ton of press. Kickstarter, Indiegogo, GoFundMe, all these types of crowdfunding mechanisms have gotten very popular very fast. There's some big advantages to crowdfunding: the power and the size of the crowd, the fact that it's network driven, and so getting a start can mean that the crowd actually does end up funding something that really is well worth it. It can be non-dilutive funding. If you're not doing investor funding, if you're doing rewards-based funding, it's a way of raising money without giving up any ownership in the organization. It can be very closely linked with your PR strategy, as well as a potential go-to-market and customer development strategy. It provides a mechanism to do direct experimentation and engagement with your customer base. Very often, your customers are also your funders. There might be limited time and effort in the fundraising process compared to a traditional capital raise. It could be weeks or months instead of a half year. And there is that value of the network in the long run. Once that network's in place, they can advocate on your behalf. There are also some big disadvantages in crowdfunding. One is the lack of expertise in your support base. More often than not, the people who are making these kinds of investments or contributing, other than as customers, they have no direct expertise. You can't rely on these people to help you run your business. And in particular, if you've gone the route of equity or investor crowdfunding, you now have a group of probably unsophisticated owners that you have to report to on a regular basis. Failure can be very public. I've given you a link here to a project that I had some personal familiarity with. A connection of mine who tried to do this product for a iPhone case charger that ultimately was unsuccessful. And you can see it ended up being public. Now, not everyone knows the people behind it. They managed to retain some anonymity, but be aware that that can be a significant and problematic outcome. The other disadvantage is it relies on your online platform skills and intermediated storytelling. If you're not good with being online, with telling your story online, with recording videos of yourself, if you're not going to be good about interacting with your crowdfund base, this might not be the right approach for you. Ultimately, crowdfunding is really a microcosm of your business. It requires planning and hard work. You still need to have some kind of product that solves a problem, and you have to go through all these processes that you would do otherwise in your business. And that can be either good or bad. It can be very good because it's practice. It's an opportunity to really test out what you're doing. It can be bad because it may force you into this a little faster than you were ready. Some people launch a crowdfunding site and campaign before they really understand what it is that they're trying to do. Now, the downside of that may be relatively limited because perhaps the crowdfunding campaign simply fails and you have an opportunity to kind of learn from the experience. So it isn't that you shouldn't do it, but be aware that it's not a simple put up your campaign site and the money comes rolling in. And in fact, if you'd like to see, to hear about an example of this, and it's a great fun story as well, a colleague of mine, Dennis Frydrych, and I wrote an article about a very specific crowdfunding example. It also has some wonderful stats about crowdfunding in the background. A specific crowdfunding campaign. Corey Cullinan, an old friend of mine from college, who's also known as Dr. Noise, wanted to do an opera for children. And it's just a great story of how this came together and the real challenges associated from it. And Corey let us watch the entire process from start to finish with all of the underlying details and access to the people involved. So there's a published article, but you can download it directly via the recommended readings in Canvas. It's an article that's written for managers. It's not an academic article. So it tells the story, and I think you'll find it likely to be very interesting to hear what really happened behind the scenes in the crowdfunding campaign. So hopefully this gives you a quick introduction to bootstrapping and crowdfunding as early stage financial options separate from raising private capital. And in the follow-up presentation, we're going to tackle sort of the exciting and sexy world of private equity funding that goes along with early stage ventures.